Hello and welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. And this is the first episode of 2021. It is Friday, I think. Friday, January 8th, 12:12 in the afternoon, Eastern Standard Time. And let's get right into it. So it's been a while since I last recorded. There really wasn't a whole lot of trading towards the end of last year, and also with the last couple weeks both being shortened trading weeks. So basically, the last two Fridays have been off for either New Year's or Christmas. So trading really hasn't been that involved. Financial markets have been moving though, and even though there wasn't a lot of trading, I was still in the market. So, well, let's just jump into the dashboard. We'll get a feel for the market sentiment, and then we can get back into the trade book and like recent trading activities. So, the dashboard. I'm looking at the S&P crude oil, the dollar, U.S. dollar index, gold, and the U.S. 10-year Treasury. Across these five markets, kind of gives me a feel for the overall sentiment in financial markets. And just to throw out what the dashboard is telling me right now, I'm looking at the S&P, which resistance is above the S&P right now. So basically, the market is set up to move higher. Same thing with crude oil. Resistance is above, so the market is set up to move higher. The dollar, gold, and 10-year, they're all setting up to move lower. The dollar, not so much in the last two trading sessions, I want to say. But standout, definitely gold, then the U.S. 10-year. The U.S. 10-year stands out because it doesn't necessarily match the magnitude that we're seeing in stocks. I mean, it is matching the direction, or at least the relationship, the inverse relationship. So over the past few trading sessions, the S&P has been drifting higher. The U.S. 10-year Treasury price has been doing more than just drifting lower. It's been actively being traded down, which again means that as the price on the bond falls, the interest rate or the yield on the bond goes up. So then that just represents that hedging or that inverse hedging relationship between equity markets and fixed income markets, in particular the S&P 500 and the U.S. 10-year Treasury. The dollar's been falling. It's been this this directional trade that has a lot of institutional support. So there's a lot of a lot of big money behind the short dollar trade. Macro fundamentals, it's up in the air, but looking at some long-term charts, I am seeing some technical targets on the dollar, and the more convincing target is actually lower than higher. So I can find some technical targets for the dollar, but as far as a fundamental reason why it is doing what it's doing, I mean, the narrative doesn't hold, but hey, I mean, I guess because it's just like, if things are looking up, then I can understand the sell-off in the dollar as investors seek better returns internationally. but they're kind of not. And then also, the stock market, but hey. Let's see, crude oil. The target for crude oil is definitely above. So I was looking at a long-term chart of crude oil today, and I mean, from where it is right now, crude oil trading around $51.60. I'm looking at a target at around $60. So that's another $8.50 from where oil is trading right now. And then above that, we're honestly looking at about $75 per barrel. So, from a technical standpoint, there's room for crude oil to go higher. OPEC is more than likely going to do its part. But, it'll be interesting to see what happens or how OPEC responds if, as oil prices keep drifting higher, if U.S. shale producers start coming back online, it would be interesting to see how OPEC then responds to that, and more specifically, the Saudis and the Russians, OPEC Plus, I guess. Yeah, so that's the dashboard. So overall, dashboard is flashing risk. Let's call this risk on, but in a weird kind of way. Because I'm looking at the S&P or stocks and crude oil as the two asset classes that are pointing higher right now. And then the dollar, gold, and the US 10-year, which basically all forms of liquidity are being sold off right now. So the dollar is selling off. Gold is a store of value, as a form of liquidity, is also being sold off. And the U.S. 10-year Treasury as a store of value and liquidity is also being sold off. So you have a market that's selling off liquidity and buying risk. So that's definitely a risk on feel to the market, at least according to the dashboard. The relationship between gold and the 10-year and the way that they're trading together, I mean, the thing that those two have in common, honestly, would be they would intersect somewhere around inflation, or the concept of inflation. The 10-year Treasury, is a store of liquidity. It's a risk-free rate that's factored into investment asset pricing models around the world. But there's also the interest rate aspect of it, not just the liquidity aspect, because we're seeing rates rise, and interest rates would be rising in response to rising inflation to maintain some level of real return. So now I have been hearing this narrative of increased or a rising inflation expectation going into 2021 into 2022, and if the inflation expectations are rising, the market rates in anticipation of that would rise as well to maintain some kind of a real rate of return. So maybe that's what we're witnessing in the 10-year Treasury market. Just inflation expectations of investors are starting to increase, and that could be as a result of the prospect for more stimulus spending, more fiscal spending from the federal government, which, reasonable enough assumption, right? They keep borrowing and spending money, eventually, prices start going up. But in all honesty, I don't think the Federal Reserve would be too upset at, prices starting to tick higher and inflation expectations ticking higher, because then that would put them in a position to be able to normalize monetary policy versus just being stuck in a liquidity trap like Japan has been for the last 30, 40 years. So, But again, to see gold sell off though in response to that, just means that market participants expect prices to tick up, but they also expect the central banks to maintain real rates, so that they do expect short-term rates to respond to rises in inflation, which, I mean, I don't know, that kind of may or may not jive with what's being said at the Fed, because they're talking about, because short-term interest rates, or inflation actually, because inflation has been below the 2% target for so long, pretty much a decade, that in order to maintain a long-term average of 2%, the Fed would have to let realized inflation drift higher than that 2% target and stay there for an extended period of time, so that the average over the long term equals out to 2%. So, I mean, I can actually see, we should probably see gold appreciating if inflation expectations are picking up, simply because the Fed has telegraphed that it's willing to let inflation run a little bit above its target for an extended period of time, just to maintain their long-term average. So yeah, but in the meantime, gold selling off. The trade looks like it has a lot of momentum behind it. So, I mean, if you can find your technical entry points, you can definitely jump on that short. The target that I found on my longer term chart for gold is somewhere around 1775. It's more than likely not gonna go there in a straight line. It's trading at about 1850 right now. So, I mean, you're easily looking at another like $75 on gold from where it is right now. So, I mean, it's not a huge it's not a huge move, because as for comparison, gold is down $61 today, and that's a 3.2% move. So another $75. I mean, you're looking at what, a little bit more than 3%, another 3%, and it's at that target. The 10-year Treasury, similarly, there seems to be a lot of momentum behind the short right now. So, I mean, if you can find your technical entry points, you can go ahead and do that. Look for your targets in between. So just ride that buildup of momentum, and as you see the momentum crescendo, you start paring back your positions. But yeah, the target on the U.S. 10-year Treasury right now, it's trading at like 136, 180, and the target on this thing is like at 132, 200 or something. So like that one actually has like a little bit of room to run. So that would be interesting. I'm looking in the coming weeks to see if I can position some options on that, because I've done a lot of short-term options trading on the 10-year Treasury. A lot of like intra-week stuff. But looking at a bit of a macro trend like this, going into next week and in the coming weeks, I'll see if I can sneak some kind of a tier strategy in there to do a little bit of a exposure management over a longer period, by just kind of like tiering or laddering some short and medium, intermediate term positions. But that's for next week. The cash position in the account's already set, I guess, for this week's trading. So let's go. But yeah, gold is falling out the sky right now. Even as I'm looking at the chart right now, it's just it's just dropped down another couple bucks. Dollar index, same thing. Dollar index currently trading at about 89.99. let's call it. And the target on that one, somewhere around 87. So there's room to go on that. And then S&P and crude oil, we talked about crude oil. S&P, medium-term target for S&P, not too far above where it is right now. We're currently trading at about 3,800. 3,800. And the target I'm looking at is about 3,905. So between crude, the S&P, and gold, their targets are fairly close. The dollar index and then definitely the U.S. 10-year Treasury, they have a little bit more room to run before they run into any kind of long-term support or resistance levels. So that's the forecast of the dashboard. Now we can just jump right into the trade book. I guess before we even get into the trade book, right? So, looking back over the week and a half that I really didn't do too much recording. The only thing two things actually. Commodities were on a tear last week. Actually, last couple weeks. The two that I was able to participate in was gold and corn. So I was looking at, taking back, a couple weeks further. I was looking at a longer term chart on gold, and this bull flag pattern kind of caught my eye. And I'm like, okay, well, just looking at a 1 year chart, so it's a decent amount of data. It takes a while for a trade like that to play out. So, a couple weeks in, caught a bit of a pullback, put in some support. I was able to. I had just a call spread and an outright call, just kind of tiered out 1 week, and then expiring basically, each Friday. That was a nice little pop from about 174, 73 to about 181. The trade lost a lot of momentum really fast. Just stalled out, just in the air. Got kind of spooked, got out of the positions. Really good timing. I mean, other than like the sudden loss of momentum, there really weren't too many signs that, gold was giving up the ghost, so to speak. So, but yeah, was able to get out of that. That was a really nice way to start the year. And then there was corn, which, I mean, for about a week or so, pushing 2 weeks, the thing was just, like, I would enter a position and I would look for, I'll basically start trading, like a counter position. So I would start setting up my charts, looking for a technical reason why I should get out. And I just couldn't find one. The thing just kept, blowing through targets, hitting limits, it just kept going higher. So that was interesting as well, because that one also started off with I had a call vertical, and then an outright futures mini contract, and I used those to play corn exposure over the past couple weeks. That was also profitable. And then I've basically just been using the proceeds from those trades to add to the equity positions. And again, the stock market just keeps drifting higher, regardless of what's happening in the headlines, what's happening in the news, or in the real economy. The stock market just keeps going higher. So whenever I have proceeds from trading derivatives or other parts of the market, I always take a little bit of those realized profits and reinvest them into the equity side of the portfolio. Simply because the stock market just keeps going higher, so I might as well participate. But looking at the trade book, current trade book, pretty simple. The a lot of the momentum lately has been in the short dollar trade, so I've been looking at a couple of trades that have strong correlations with the dollar, and I've been trading those. So the first I have is corn, which is just a residual from the past couple weeks. What I've been seeing is it has a strong run up, so breakout, then it consolidates, resets, and then breaks out again. So I rode the last run up post the previous breakout. I'm sitting in the position while it bounces around sideways in its consolidation, in the anticipation of from here it breaks out higher. And especially if the dollar keeps drifting lower. Because as the dollar goes lower, commodities priced in the dollar reprice higher. And the rest of the trade book are currency based. So I've got the Aussie US dollar futures. It's a micro, it's an e-micro Aussie US future contract. Again, just kind of trying to intersect that short dollar, long commodities play. And then from the dollar index perspective, I look at the Euro US dollar futures. It's e-micro futures, and then I even throw in a spot Euro US dollar forex position, just to take advantage of the long-term momentum behind that short dollar trade. So the correlation between the corn and the dollar, it fluctuates, it varies, so it kind of has its own macro fundamentals that's guiding it, which is good because on a day like today, the dollar index is pushing higher. So of course the Euro futures and the Euro US dollar spot are down. But the Aussie US dollar futures, it's actually up on the day. And then of course corn is up on the day. So the Aussie US dollar futures is probably more closely correlated to corn, or the rest of the commodity complex, than is the euro. So those two sides of the portfolio kind of trade sometimes together, sometimes not so much. But that's fine though, because a little bit of diversification works. And just for the hell of it, I have it's a call vertical on the U.S. 10-year Treasury. Now this is something it's running counter to the actual trend in the portfolio. So right now, it's down. It has another 9 days, maybe 8 days, 7 days to expiration. So it expires next Friday. As it currently is right now, the contract is down to its maximum loss limit, which is fine because I got it really, really cheap when the market was already moving. So max loss per position is like $32, $31.25. So the upside on it, I think, is like $2.18. So between now and next Friday, if we get a sell-off in stocks, a rally in bonds, something that I paid $31 for can yield something somewhere around $150. So, I mean, I thought that was a bet worth taking, just because the market ran so far in one direction this week. So, but if it doesn't, if it keeps going, The spread expires next Friday. Max loss 31.25 per position. Not a big deal in the grand scheme of things. And I'm actually looking forward to reposition anyway on the 10-year Treasury and reverse the direction of that trade. So I'm gonna hold on to this one. This one. I'm gonna hold on to this to that vertical, because you never know between now and next Friday, right? You never know. But if it does, great. If it doesn't, it's already, max loss is already factored into my net liquidating. So yeah, that one's kind of like a non-factor unless we get some kind of a sell-off or a melt up in 10-year Treasury prices next week. But, and also looking at gold, I mean, I'm interested to see how it closes out the week, trading around the because basically it broke out of the top of the channel and the bull flag, and then just basically crashed back into it. So going into next week, I'm interested to see if, well, two things. One, if the price then having broken out of the channel and then broken back into the channel, it retests back to the channel and holds it as resistance, which would signify that it's probably going to move to the lower bound of the channel, and then it'll be an all-out short for gold. Or if the price breaks back out of the channel and then holds the channel as support, then we know that gold is turning around. It's just consolidating to go higher. So we'll see how how the price plays around with that channel level. So whether it holds as support or resistance, or if it just keeps going through it. So then hopefully we get some more clarity next week, and also an opportunity to enter a position in gold. So as it is right now, I'm looking at a bull flag pattern, which means the price should be going higher. But in the interim, if the price does duck back into the channel, then it'll be a great opportunity to short it. And I haven't completely checked. Let's do that right now. So if I zoom out, I'm looking at this chart of gold. Alright. I'm trying to find the one with the bull flag pattern on it. Oh. So yeah, long story short, if gold does duck back into the channel, then the target of 1775 is in that lower quadrant of the lower half of the channel. So I mean, reasonable enough to expect that it can actually go all the way down to the target, and then maybe even lower. You never know. But that's so that's going forward. That's thoughts on gold, thoughts on the 10-year, and of course the dollar index. I'm already positioned in that one. The goal is to hold out with the euro futures and the euro spot position. And I think looking at oil keeps pushing higher in conjunction with the dollar moving lower. That should be support across the board for the commodity complex. So that should benefit the Aussie position. That should also benefit the corn position, and other commodity investments as well. Gold, not necessarily trading like a commodity right now, more like a financial instrument, similar to a 10-year Treasury. It's selling off in line with that market. And then the dollar, of course, institutional money short, so dollar short. But okay, so that gets you guys caught up to speed as far as what I've been doing Trades I've been trading. Let's see. Yeah, that's it. So okay, now I'm looking at gold, and the support level that it put in previous when it broke out of the channel, or right before it broke out of the channel, it broke through that support level right now. So that's the first signal to me on this longer term chart that gold may be setting up a short. So now, being that the price broke through a previous support level, I'm going to personally wait until the price retraces back to that level and confirms that that support level is now a resistance level. So it took a lot of, or it's taking a lot of momentum to push gold down as much as it is today. Once that momentum dries up, value investors, value seekers are going to come in. They're going to bid the price back up a little bit as they buy at the lower price. But if the main trend holds, then maybe 2 or 3 trading sessions after you see that pullback and consolidation, you'll see that continuation down. So, I mean, from my perspective, it gives me a couple days to a couple trading sessions to position myself in gold. So that's fine. It's always good to kind of have a little bit of a forewarning to these things. It gives you time to plan around it, because you don't want to just be committing cash all willy-nilly, because hey, you never know what kind of opportunities tomorrow will bring. So in my case, being that the exposure, long story short, I'm looking at gold going into next week, and it could be a short. The short dollar play, I think that just gets back on track as we get back into next week, and that's how I'm positioning on that one. I am, however, looking at some levels on the dollar index which could signify a reversal. So that's always important from a technical standpoint, when especially when following a trend, or just betting on momentum, that you keep up with your technicals to make sure that when it's time to get out, it's time to get out, and you get that clear signal. So that way, you don't just get caught, like you don't let your money management breakers take you out of a market. So like a margin call or something. You want to let your technical breakers take you out by just crossing support and resistance, or looking at reversal candle patterns, stuff like that. And along those lines, if you do want to learn more about technical analysis, and if you do want to learn more about trading like a Wall Street pro, you can visit rtn.education, and you can find a lot more resources to point you in the right direction when it comes to trading and technical analysis. And like I keep saying, you learn technical analysis, you can trade any instrument in any market. Okay. And on that note, if anyone has any questions, comments, or concerns, you can reach out to me at contact@runthenumbers.biz. That's contact@runthenumbers.biz. And that being said, you guys have the weekend. So have a happy weekend. Hopefully your trading week was successful. If it was, congratulations. If it wasn't, hopefully you made notes. You can make corrections and try again next week. So on that note, happy trading, and when in doubt, take profits.